down. I'm going to continue with Dr. Ranade. As I said, he's amongst the most famous names that I know on the economy. And Dr. Ranade, we heard Mohit speak about the Indian real estate on the residential side, and he also referred to the Indian economy, which was growing at 7% per annum, whilst the real estate wasn't really growing at that pace. And then suddenly COVID hit us. Would love to have your opening remarks on really touching probably two or three things. One is, when do we get back the economy to the pre-COVID levels? We hope that the low interest regime, continues. And where do you see real estate within this overall economy, and what do you think is its contribution going to be?
Thanks, Anuj. Thanks for the very kind words, and thanks, Mohit, for the great opening remarks. Wonderful to hear about your views and outlook. And first of all, real estate is become a very respectable term, if I may say so. In a lighter vein, I know that I'm kind of treading on some maybe, but the more formal the economy gets, so we are seeing a transition of more what I say formalization of the economy from informal to formal, and therefore real estate is a very important part of the economy. And let me just illustrate by one little point, Anuj. See, everybody, Marathi, Hindi mein bolte ek muthi asman. Everybody aspires to have a little muthi of real estate, maybe. But if I'm a middle class, a lower middle class person, I can't afford to buy a 2 crore rupee home. But surely I want to invest 5 lakh rupees in real estate. So the formalization of the economy, what I mean is that that's what it makes it possible. I'm not talking about a 5 lakh rupee home. I can get a piece of that pie. So with the evolution of more formal structures of the economy, formalization, whether it's real estate investment trusts, real estate investment vehicles, so all that stuff means, traditionally we say in India, we have some 20-25% of national economy, national income as savings rate, but half of it goes into real estate and land. And we traditionally poo-poo that by saying, oh, that is unproductive investment because it's illiquid. What we mean by that, it's not as if rest of the world doesn't invest in land and maybe gold as well. But there, the real estate, housing, everything is financially integrated. It's very much part of the financial sector. It's very much part of the formal economy. What is happening in India is we are seeing this transition, and every successive year brings much better financial integration of the real estate sector. So I think that's my opening observation. And even before the budget, by the way, in December, as you know, in Mumbai city where we live, had the highest sales, I think, in 10 years or something. And
that's right.
I was privileged and fortunate to be part of that committee which had recommended that stamp duty cut. I think Mr. Deepak Parekh, of course, led and it had a remarkable effect. But just if you allow me 2-3 minutes, the reason I think the budget was a landmark budget is because of, I think, 5 factors. Very quickly, first of all, no new taxes at all, because prior to the budget, there was a lot of talk of a cess, COVID cess, or a inheritance tax, or a wealth, real estate tax or something. So no new taxes, number one. Secondly, a great degree of transparency, frankness, honesty in presenting the true numbers. Thirdly, a sort of a fearless ambition about going to deficit spending all the way to 9.5% this year and 6.8% next year, and going down to 4.5% only after 4 years. So really fearlessness on this things like the bogey of rating agencies, of sovereign rating agencies, who have always treated India unfairly, I think. So that's the third factor. The fourth, of course, important thing is a huge space opening up for the private sector, including the use of the word P, the P word as they call it, privatization, disinvestment, FDI in insurance. For example, in real estate, the removal of the TDS requirement for sovereign wealth funds and foreign funds that are coming into real estate or infrastructure. And the fifth factor, I think, of course, is the overall infrastructure push, the national infrastructure pipeline. And in particular, I think that for real estate in particular, the extension of the tax holiday or whatever, that affordable housing deadline by 1 year, and the huge, the actual data on the infrastructure pipeline. By the way, the national infrastructure pipeline, the reason it's important is because it's got a lot of connectivity stuff going on, whether it's roads, ports, metro stations, and connectivity has a spillover effect on real estate. So I'm not talking about the affordable housing part, but just the fact that you have more connectivity means, so I see that as a positive for real estate. And of course, there's a bunch of reforms in banking, including recapitalization, and the tax exemption, I think, given us on the affordable housing, in some extension there. So I know that one can do a little nitpicking and say, oh, more could have been done. That's always the easiest thing to say about every budget is, oh, missed opportunity on X, Y, and Z. But I think, as you said, and I heard you say earlier in our discussion, that this is one of the best years after a gap. What happens is when you have a 6-7 year period of not so inspiring and not so appetizing outlook, you kind of get used to it, and you don't realize when the good times have started. So I think we are probably entering a multi-decadal, if not a decadal kind of boom time, if I can call it that. I'm trying not to sound like a Pollyanna, but I can give you more data to support what I'm trying to say in terms of the mega trends of urbanization and demography and so on. But maybe we should get into that with our conversation.
Yes, absolutely. Dr. Anand, this is very nice and absolute music to our ears. Because real estate really piggybacks on the economy. If the economy is doing well, more than likely that real estate will continue to do well. I'd sort of 5 or 6 quick questions if I can ask you, because as I said, you're amongst the best brains that we have. What can go wrong from here on? I know there's a lot of positivity every day. You read the newspapers, we are V-shaped recovery, cases are coming down, vaccine is there, the tax collection has been one of its highest, and clearly the government seems to be in control of the situation. What do you think can possibly go wrong, which may derail?
No, before I say what can go wrong, I want to emphasize what you said about vaccine. See, the response to the pandemic is threefold. One is vaccination, which is preventive. Sorry, vaccination is treatment, actually. Then there is the protocol themselves, the social distancing, the masks, and so on. And then there's treatment. You see, the recovery rate also has improved drastically. So we have learned quite a bit in the last 8 or 9 months. So let's not forget that. Secondly, as you said, all the indicators, whether it's lead indicators like Purchasing Managers Index, PMI, or it's IIP, or it's the GST monthly tax collections, or it's the accumulation to foreign exchange reserves, or it's the stock market, all these indicators, lead indicators are going in the right direction. In fact, IMF itself has upgraded the outlook on India, and now IMF's growth forecast is higher than the growth forecast of the finance ministry, So what can go wrong in this recovery? See, there is always the devil is in the implementation. I would say that's one thing that for example, vaccination. Mr. Nandan Nilekani says we should be administering 5 million doses a day. We are struggling to get to 1 million. So I don't know whether I don't know whether you should call this as something that could go wrong, but instead of getting everybody vaccinated in 8 or 9 months, it'll take us a year and a half. But it's still progress, The other thing is, I'm worried a little bit on the fact that the fiscal deficit, while it's ambitious and fearless in terms of the rating agencies, but we still have to fulfill 12 lakh crores of, there's a shortage of 12 lakh crores. There's enough liquidity, as you know, in the banking, but in trying to generate 12 lakh crores and leave enough funds so that the private sector people can also borrow and real estate projects can take off, we might see some upward pressure on interest rates. And that's definitely something to worry about, because if there's one variable that real estate industry is very sensitive about, as you know, especially commercial, is interest rates. So the RBI will have to do a real super balancing act. On one hand, maintaining enough liquidity to make sure that the funding for the borrowing program goes through, but at the same time not have excessive liquidity so that it leads to inflation. And this is, I know, I don't envy the task of the Reserve Bank. So I think that to me is something we need to be careful, watch about.
So the IMF, sorry, Kashmira, you were saying something? No. So, sir, on the IMF is projecting, I think various agencies are saying is GDP growth at 11.5% for India. But if you were to look at the degrowth that has happened within the current financial year, effectively it's probably 3.5%, your growth. When do you think we're going to get back to the pre-COVID levels of growth in the economy, or 6, 7, 8% that we were talking about earlier?
There is enough room for actually an upside surprise. So this year the growth rate, current estimates are -7. So we are not still through with this financial year, which ends in March. -7 might turn out to be -5, and next year +11 might turn out to be +12.
Wow.
So after we at the end of FY22, which is March 22, we will have grown by around 3% in 2 years. So average growth of 1%, 1.5% per year. But at this stage, we need to only look at the aggregate size. India is a 220 trillion rupees economy. And we're getting close to $3 trillion economy. So even at zero, I mean, this is my favorite line, that when the economy the size of US, when it grows at 0%, that means it produces 17 million new cars. That when you produce 17 million new cars in the US, you're just growing at 0%. You're just producing same as last year. So when you have an economy, India's size is $3 trillion. So when you produce, let's say, 10 lakh new homes, that is zero growth, something like that. So let's not ignore the size of the economy. You're right that we need to be growing at much faster. Aspirational growth is maybe 6-7%. We'll get to that in a couple of years. But if you look at the V shape, so after the V shape, we'll be in 2 years, we'll be ahead by about 2-3% only.
Nice. No, this makes it very clear. And sir, everywhere that we read, when events took place, like the World War II took place, there was a geopolitical change that happened, and the rankings of the countries in the world order changed. Do you think India will go up on the ranking as we come out through this pandemic?
There's no doubt about it. There's no doubt about it. I told you that mega trends, for example, demography, in the next 20, 30 years, 35 years, India is going to add 250 million people to the workforce. In that same period, China is going to subtract 150 million from the workforce. And India and China, this is a century which belongs to India and China, frankly. India and China together account for 40% of humanity. Whatever you might think in terms of Indo-China relationships, this is a century where the center of gravity has decisively shifted to the Eastern Hemisphere. The growth is going to be concentrated in Southeast Asia, East Asia. And India, there is no doubt in my mind that India is definitely the growth center. And the mega trends are the mega trends like demography, urbanization, all these are in India's favor. Going back to your first question, what worries me? Yeah, I said interest rates in the short run this year because of the borrowing program. But of course, one other thing that we need to worry about, which is not really something that you can deal with on a yearly basis, is that we should not let our inequality get out of hand. Whether it's income inequality or wealth inequality or regional equality, we should keep an eye on that. That's a consequence of growth. That's not the determinant. But this is something that's why policymakers need to keep an eye on that as well.
Yeah, no, I agree with that, sir. If there is inequality, it can create a huge amount of disruption, within the structure, of our country, and clearly that is one thing that we cannot afford at this stage. And the last one that I had is that you briefly touched about it, and it is a little concerning that the low interest regime may not continue for a long. What do you think is the real probability of this low interest regime not continuing, given the balance, as you rightly said, has to be done between liquidity and the interest rates?
Yeah, that was the first question you asked about what is the worrying, what is the risk? So because we have a large borrowing program, and we have a large borrowing program because the government is ambitious about its fiscal spending. It's ambitious about its pump priming. It's ambitious about fiscal expansion. And to that extent, since we need to fund that borrowing, it'll come from the same space of loanable funds, which is the bank deposits and savers. And at the same time, private sector also has to grow. So the same pool of funds is going to be available for the private sector as well. And in that tussle, in the tug of war of the big gorilla, which is Government of India borrowing 12 lakh crores, and maybe another 10 lakh crores being borrowed by the private sector. In this tussle, maybe the pool of savings and liquidity won't be enough, and that's where the interest rates are going up. But remember, the world has lived with zero interest rates now for 10 years, 12 years, 10 years at least, 11 years, since 2009. So if we can't borrow domestically, we should borrow overseas. Those stronger players, especially who have access to dollar funds, should actually access the overseas markets. This year, I believe the rupee is actually going to get stronger. So if you borrow today at an exchange rate of 74, next year you'll be repaying at an exchange rate of 73. So actually, cost of borrowing will go down. I'm not suggesting that you take unhedged forex risk, and I'm not saying go and start gambling in the foreign exchange market. But India's exchange rate and rupee is actually on a stable path, stability, and in fact it's an appreciating bias. So that will attract foreign funds into India. So we should look at the pool of savings, not just in India, but overseas as well. And to that extent, the interest rate pressure will be lower. But I won't be surprised if there's slight inching up of interest rates from a very low, not very low, to maybe slightly moderately higher. That has never deterred growth, by the way. As you know, the mid-90s, we had 7-8% growth when interest rates were at 16-17%.
16, yes, that's right.
We are the 10-year G-Sec at 5 or 6%, so we're much lower. So I don't think that should deter us from the growth aspiration.
And then you're absolutely right, Dr. Andre. The home loan rates used to be 16, 17, 18%. And yet we were seeing, growth in the GDP of 7, 8, 9%.
Yeah, you get a 15-year home loan at. It's possible.
That's right.
I'm not here to count any home loans, but I've been quoted that number. So.
No, this is fantastic. I can tell you, Dr. Andre, the audience would like me to go on and on. This is so positive. This is absolute music to everyone's ears. And fantastic if the country, if the economy can really arrest the downfall in the GDP growth within this financial year, and correspondingly have a upliftment on the projected growth of 11.5%, we're going to come out real winners. And as you rightly said, is that the geopolitical situation is going to be in favor of India and China. And whatever we say about the relationships between China and India, I mean, these are the two mammoth economies, and this is where we are going to largely see the growth. I know we've run out of time. I'm going to quickly, announce the unveiling of our consumer sentiment survey. And Dr. Ananda, you'll be quite excited to see what the survey has said on real estate purchase. And they've given their perspective from the lens of the consumer. And this is a beautiful comparison between pre and post-COVID. So if we can unveil the report digitally, Asim, that'll be great.
Sure.
Thank you. Thank you, Asim. I'll just give you a quick highlights, 8 or 10 points on this one, what we have seen during the survey in the report. Clearly from pre-COVID level, when there were 54% of the survey attendees who had said they would love to buy a property and it was an ideal time for them to buy a property, from 54%, it has moved to 62%. So, clearly it has moved in favor of what exactly Mohit was also saying, that we're starting to see a lot more interest come in from the home buyers. It is clearly an end user market. You will see after I finish giving you anecdotes on the report, there's a presentation 2-minute video on that, and clearly a higher demand for larger homes. And, Kashmir, ma'am, you and I were discussing about this. We're saying is because work from home has become very popular, people are asking that extra half a room, half a bedroom. So instead of 2 rooms, it's 2.5 rooms. 3 room, it is 3.5 rooms. The demand is largely on the peripherally locations of the city. Previously, it used to be the central business district or the suburban. Now they're going to the periphery because they're saying we're likely to come in probably 2 or 3 days a week in the office. We want larger home at the periphery, and we'll spend more money on buying a larger home rather than buying it closer to the city. Huge amount of demand for plotted developments where people are wanting their own plots and they want to build their own home. So row houses, villas. They don't want their destiny to be linked with their neighbors. In the event that the neighbors catch a virus, the full floor was getting sealed. So a lot of demand on plotted developments. There's a lot of demand for newly launched projects. So it does appear that there is belief in the Real Estate Regulation Act, and suddenly we are starting to see demand come in from the home buyers on launched projects, which wasn't really there. Mohit earlier touched on this. The share of reputed developers from financial year 2017, which was at 17% of the overall market, has moved to 44%. At the end of 2020. So what a dramatic change. Exactly what China did, we are looking to do that. There is a new breed of developers who's come in, and Dr. Ranade, one of them is your firm as well, which has got into real estate, into active real estate development. And we hope that this is beginning of an upcycle, that we look at it from here onwards.